Steve Roach, I've got to go back to the heart of your work on Asia, and the fact is you get off Cathay Pacific long ago and far away at Terminal 1, Hong Kong International Airport, and there was the big Morgan Stanley sign that you personally put up there as you came down the ramp at Terminal Run. Those days are gone. Your new view on the new China.
Well, those were the days, Tom. I probably will never go on Cathay Pacific again, sadly. Look, China is clearly embracing a different type of approach to the balance between ideology, policy, and economic growth than at any point since I've been covering the country. Ideology is the dominant force under Xi Jinping. And what has really been disturbing and shocking to some of us is how he's used the ideology to go after the what had been the most dynamic sectors of the Chinese economy, the internet platform companies. And at the same time he's doing that, he's got this income redistribution, wealth redistribution program called Common Prosperity. And so it's a twin pincher movement on the dynamism of China. We all know the growth rate has slowed. I'm not concerned about Evergrande. I think they can definitely manage that. Their zero COVID policy is also very restrictive on a short-term basis, but I think they can get through that as well. I'm more concerned about the medium to longer term of China. I've been positive for decades, and I'm much less so today.
Stephen, you helped build the modern Hong Kong. What should be the Western bank response to all this? How does the Western banks adapt and adjust in Hong Kong?
Well, being in Hong Kong now and in the future is just like being in mainland China. There's really no functional difference between Hong Kong as a Chinese city and operating in Shanghai or Beijing. So to the extent that Western banks are comfortable operating in Greater China, Hong Kong still has a good deal of attraction to them. I understand that, there's a lot of concern because of the dramatic shift from what Hong Kong had been to what it is right now. But you just have to look at it as another big Chinese city.
Stephen, you said you are much less optimistic right now about China's trajectory going forward than you have been in decades. Can you play out what the ramifications are at a time when you see inflation is becoming more entrenched and we see supply chains that originate in China becoming more and more disrupted?
Well, the supply chain issue, Lisa, is clearly critical to the inflation outlook, and so much of the global supply chains run through China that any disruptions there, as we've seen, have a critical bearing on the supply side of most large goods-producing markets around the world. But and I wrote about this a few years ago when I first warned of stagflation. But little did I know what was going to happen on the demand side. The supply side was very fragile, to be sure, but the demand side went into lockdown, and then the post-lockdown snapback, fueled by the Fed, who is now desperately behind the curve, really outstripped what a limited supply side could produce. So the result is, very high inflation rate and the lowest real federal funds rate in recorded history. A federal funds rate today that is further into negative territory than it was in the mid-1970s and early 1980s, when we had a terrific, I should say a horrific inflation problem. So to say the Fed's behind the curve is putting it very kindly.
Well, Stephen, to build on that and to go back to your idea where you said the demand side was rather unexpected, and it plays to this elegant mea culpa that you wrote last year in August in Project Syndicate, where you talked about how your call for a double-dip recession didn't come to fruition because of this. How do you gauge the forecasting, the potential for forecasting errors at such an unprecedented time, which the Fed is grappling with as well?
Fair point. Look, you can't even forecast the forecasting errors, Lisa. They're so far off the map. I was just reading an article a few minutes ago about how some of the best sort of real-time high-frequency forecasters missed the employment numbers last Friday by a factor of 2, 3, and 4. Forecasting is always hazardous, especially as Yogi told us, when it involves the future, but this time is ridiculous.
Steve Roach, Ellen Zentner came very close to nailing that forecast at Morgan Stanley. And I want to talk, as Lisa mentions, about all the missed calls that were made in the pandemic. We need to look forward. You own the high ground on the macroeconomic analysis of savings. When you hear people talk about we have an abundance of savings, or they talk about we're using our savings up too quickly, how do you respond to what that means for 2024?
Well, I'm looking at it again right now, Tom. What I prefer to look at is the overall domestic savings rate, which is the sum of business, household, and government dissavings, reflecting these large deficits. I look at it in net terms because I want to take out the depreciation that goes for the wear and tear of capital stock. And so I look at the net domestic savings rate as a gauge for how we can domestically fund economic growth going forward. It's exceptionally low. It's about running about 2% over the last year, ticked up a little bit to slightly above 3% in the third quarter of last year. But, that's less than half the average net domestic savings rate in the final 3 decades of the 20th century. So lacking in saving and wanting to invest and grow, we have to import surplus savings from abroad. We run these massive current account deficits to attract the capital, and that will eventually, not last year, as another bad forecast of mine, incorrectly felt that the current account would put pressure, downward pressure on the dollar, but that's coming. Hold on, you will see it.